All right, today we're cracking open a pattern that's kind of hidden in plain sight, the market's own secret calendar. We're going to use 24 years of data from the super popular QQQ Tech ETF to see if history can give us any kind of a roadmap. So let's dive right in.
You know the feeling, right? It's the question every single one of us has to face. You've had an amazing run, your portfolio's looking great, but you get that nagging feeling about what's next. Do you sell and take the profits? Do you just let it ride? How in the world do you manage the risk without getting FOMO? Yeah, it's a really tough spot to be in.
Well, what if there was a framework that could help you answer those questions? Now, I'm not talking about a crystal ball, not at all. But what about a calendar? A kind of predictable rhythm that shows us when the market has, historically, tended to be strong and when it's been, well, pretty weak. This whole idea? It's called seasonality.
Okay, so let's officially put a name to this idea. Seasonality is basically just the study of these historical tendencies that seem to repeat over certain times of the year. Now, these patterns can be driven by a whole bunch of things, from big institutions window dressing their books at the end of a quarter to, just simple shifts in our mood, like the classic summer doldrums. We're going to dig into all of this using one of the most popular funds out there, the QQQ ETF, which tracks the big tech stocks in the NASDAQ 100.
And now for the really good stuff. We are going to jump into the hard data from the last 24 years. We're going to pinpoint the exact months where the QQQ has historically shined the brightest, and, just as important, the months where it's tended to stumble.
Let's kick things off with the absolute best. Looking back over 2 decades of data, the single best month to own QQQ has been October. On average, it's returned a massive 3.43%. That is a huge standout.
But for every mountain peak, there's a valley. And the worst month, by a long shot, has been September. On average, it's actually lost 2.15%. That is just a gigantic swing from October's performance, right?
Okay, now what's really fascinating about this table is the bigger picture it gives us. You can start to see these little clusters of strength. Just look at October and November back-to-back. That's a powerful year-end punch. November has an unbelievable 79% win rate. I mean, it's been in the green almost 4 out of every 5 years. And then you've got other heavy hitters like July and April. But on the flip side, September really stands out as the weak link, with February also kind of showing this tendency to be choppy and a little bit negative.
So the big question is, what do you actually do with all this information? Well, one way you could use it is with a strategy called beta cycling. The whole idea is to adjust your portfolio's risk level, its beta, based on whether you have these historical tailwinds or headwinds. Think of it like adjusting the sails on your boat to match the seasonal weather.
But before we go any further, let's just make sure we're all on the same page. What even is beta? Well, to put it simply, it's just a measure of volatility. If your portfolio has a beta of 1, it basically moves in lockstep with the market. But if your beta is greater than 1, say 1.4, it's designed to be more volatile. So it's supposed to move up more when the market's rising, but also down more when it's falling.
So how does this actually become a strategy? Well, this beta cycling idea breaks the year down into 3 seasons. During the historically strong months, like October and November, you might aim for a higher beta, maybe around 1.4, to be a little more aggressive. In the more neutral months, you'd dial it back a touch. And then in the historically weakest months, like September and February, you'd shoot for a more defensive beta, something closer to 1.1, just to try and reduce some of that volatility.
Okay, so what does that actually look like? This is a great example of a high beta portfolio. In this case, someone might use a leveraged ETF, like QLD, which is designed to amplify the daily returns. They'd use it to crank up their portfolio's beta during those strong seasonal months. You can see how the mix is tilted more aggressively towards that leveraged fund.
And here's the complete opposite. This is what a defensive portfolio might look like for a month like September. You see how the allocation to that leveraged fund, QLD, is way down, with a lot more of the money just sitting in the core QQQ? The goal here isn't to jump out of the market entirely. It's just to dial down the risk when the historical data suggests a little bit of caution might be a good idea.
Okay, this all sounds pretty neat, right? But now we have to have a major reality check. It is absolutely 100% crucial to understand that seasonality is about historical tendencies. It is not a book of ironclad rules. The past does not predict the future.
Come on, you've seen this disclaimer a million times, and there's a really good reason for it. It is probably the most important rule in all of investing. I mean, a month can have a 70% win rate, which sounds great, but that still means it flat out fails 30% of the time. This is a tool, not a time machine.
And it's so important to remember what really pulls the levers of the market.
We're talking about things like interest rate decisions from the Fed, big reports on economic growth, and of course, corporate earnings. Any one of these things can come along and completely blow a seasonal pattern out of the water. Seasonality is a secondary factor. These things on the screen, these are the primary drivers.
Honestly, here's probably the best way to think about all of this. Seasonality is like the climate. You know that, generally speaking, winter is cold and summer is hot. But that doesn't stop you from checking the daily weather forecast before you decide what to wear, right? That daily forecast, the earnings reports, the Fed announcements, is always more important than the general climate.
So, let's try and wrap this all up. How can you take this concept and use it in your own thinking in a responsible way? Really, it's all about creating a new kind of mental model for how you look at risk and opportunity throughout the year.
If you remember one thing from all of this, let it be this one sentence. Seasonality can give you a hint about when it might be a good time to be aggressive, like in October, but it's all the other critical indicators, like the economy or what's happening with a company's earnings, that tell you if you actually have the green light to hit the gas.
And that really leaves us with the final question, doesn't it? Is seasonality a real market edge, or is it just a kind of market illusion? The historical data is pretty compelling, for sure, but the future is never, ever guaranteed. So ultimately, you have to decide what role, if any, this idea plays in your own strategy. Thanks for watching.